Welcome back to the series. This is episode 10, the profit and loss statement. This is the document that tells you whether a company actually makes money. Let's get into it. Last episode, we read the balance sheet. We looked at what a company owns, what it owes, and what's left over for shareholders. But the balance sheet is a snapshot. It's a single photograph. The profit and loss statement, the P&L, is the film reel. It shows you what happened over time. Every dollar that came in, every dollar that went out, and what, if anything, was left standing at the end. This is the document Wall Street obsesses over every quarter. And once you understand how to read it, you'll understand why most of that obsession is pointed in potentially the wrong direction. In this episode, we're going to walk through the P&L from the top to the bottom: revenue, gross margin, operating income, net income, and the single number every investor quotes, but most investors don't truly understand. That's earnings per share. Here's the most important thing to understand about the P&L before we look at any numbers. It does not measure cash, it measures accounting profit. And those two things are not the same. A company can record a sale today and not collect that cash for 90 days. Under accounting rules, that revenue still appears on this quarter's P&L. The cash is not there yet, but the profit is. This is why we have a later episode dedicated entirely to cash flow. For now, understanding that the P&L is built on accrual accounting, revenue and expenses are recognized when they're earned and incurred, not when money actually moves. Keep that in the back of your mind as we walk through every line. The top line, revenue, is the starting point. Every other number on this statement follows from that. Revenue is the amount earned from customers during the period, the value of goods delivered and services provided under applicable accounting rules. That's it. Before any costs, before any taxes, before any deductions, pure top-line volume. When analysts talk about beating on revenue or missing the top line, that's what they're referring to. When you're looking for what you're looking for as an investor is not just the number itself, it's the direction with the durability. Is revenue growing? Is the growth accelerating or slowing? Is it coming from one customer or spread across thousands? A company with declining revenue that's somehow showing higher profits deserves a closer look. Sometimes management is genuinely improving efficiency, cutting low margin lines, divesting non-core assets. Other times, the business is cutting its way to a profitability that won't last. Once you have revenue, the next step is subtracting the direct cost of producing what was sold. That's called cost of goods sold, or COGS. Revenue minus cost of goods sold equals gross profit. The gross profit divided by revenue gives you the gross margin, expressed as a percentage. Gross margin is one of the most telling numbers on the entire statement. A company with an 80% gross margin keeps 80 cents of every dollar before touching operating expenses. A company with a 20% gross margin keeps 20 cents on the dollar. The difference in financial flexibility between those two businesses is enormous. Software companies often run a 70 to 80% gross margin. Grocery store chains run a 20 to 25%. Neither is inherently better, but when comparing two companies in the same industry, the one with the higher and expanding gross margin has a structural cost advantage. That is a potential moat signal. Gross profit tells you how efficiently a company produces a product, but it doesn't tell you how efficiently the business is run. For that, we look at operating income. Operating income is gross profit minus all operating expenses things like salaries, rent, marketing, research and development, and depreciation. Operating income is the profit generated purely from running the business, before interest payments, before taxes, before anything external to the core operation. You'll often see this used as a close proxy for earning EBIT, earnings before interest and taxes. The two are usually the same number, though the exact calculation can vary by company. The operating margin, operating income divided by revenue, is the number that tells you whether management is building leverage into the business as it grows. If revenue doubles and operating income triples, the business is scaling efficiently. If they move in lockstep, it isn't. After operating income, two more deductions happen before we reach the final number. Interest expense, the cost of carrying debt, and income tax. What's left is net income, the bottom line. The number headlines are built around every earnings season. Net income is the official accounting profit of the company for the period. But here's what most retail investors miss. Net income can be heavily distorted. Non-cash charges like depreciation and amortization reduce it. One-time write-offs reduce it. Tax strategies can manipulate it, and companies can legally accelerate or defer revenue and expenses to make any given quarter look better or worse than the underlying business deserves. Net income is a useful data point. It's not the only data point to look at, though. It is an accounting construction. And understanding its limitations is what separates an investor from a speculator. Free cash flow is often much harder to manipulate than earnings. That's exactly why professional investors eventually follow the cash. A thread we'll pull all the way open in episode 12. Every quarter, the number analysts and media focus on is earnings per share, EPS. EPS is simply net income divided by the total number of shares outstanding. If a company earns $1 billion in net income and has 500 million shares outstanding, EPS is $2. There are two versions you'll see. Basic EPS uses only the current shares outstanding. Diluted EPS includes all potential shares. Stock options, convertible bonds, warrants, that would become real shares in the future. In most cases, investors should focus on diluted EPS. It reflects the potential impact of future share dilution and is a more conservative number. Here's the critical insight on EPS that most investors overlook. A company can grow EPS aggressively while revenue is flat or declining, simply by buying back shares. Fewer shares outstanding means the same net income divides into a higher per share number. That can be legitimate capital allocation move, or it can be cosmetic financial engineering designed to hit bonus targets. Knowing which one you're looking at requires going beyond the headline. Here's how a fundamental analyst reads the P&L in sequence. Start at the top. Is revenue growing? Is the growth durable? Move to gross margin. Is the company keeping more of each dollar over time or less? Look at the operating income. Is the business generating operating leverage as it scales? Check net income, but verify it against cash flow in a later step. Accounting profit and economic reality are not always the same number. And when you read EPS, know whether that growth came from a better business or from a smaller share count. The profit and loss is not a verdict. It's a set of questions. The answers in those questions confirmed across multiple statements, across multiple years, that's where your edge as an investor will live. Before you close out this episode, run any company you're researching through the checklist on the screen. Growing revenue, stable or expanding margins, operating income outpacing revenue, net income checked against cash, and earnings per share growth you can actually explain. In episode 11, we move to valuation ratios, the price to earnings ratio, price to sales, price to book, and enterprise value to EBITDA. We'll show you what each one actually measures when you use it and when the market is using it to mislead you. Please, if you enjoyed this, like and subscribe. Have a good day.